When we talk about investing, you hear a lot about shareholders, what they want, what they've approved for a company, how they're feeling and voting. But what exactly does being a shareholder involve? A shareholder is any person or organization that holds at least one share of a company's stock, making them a partial owner of the firm. This entitles shareholders to make or lose money when the company distributes earnings, such as paying dividends, or when the price of shares rises or drops. If the company fails, shareholders will be the last in line to claim any of the firm's remaining assets, and they could be out a lot of money depending on how much they invested. If a company succeeds, shareholders can profit handsomely. For example, shares of Google first hit the market at $85 in 2004. Those same shares would be worth today more than $6,000. On the other hand, anyone who held shares in General Motors in May 2009 saw their investment completely wiped out when the car maker declared bankruptcy. Shareholders are also entitled to receive dividend payments, which are cash distributions of the company's profits that are paid directly to shareholders when the company is doing well. Some companies have paid steady dividends for years, providing income in addition to share price gains. But just because you're technically a part owner of the company doesn't mean you can walk in tomorrow and start giving orders. Shareholders do have certain rights, but their influence is channeled through the company's officers and board of directors. How much of a say a shareholder has depends on how many shares they hold. The more shares, the more power. Large institutional investors, such as mutual funds, can influence a company's actions because they control a large portion of shares, which gives them more voting power when shareholder decisions are made. At the annual shareholder meeting, investors get to vote on approving members of the board of directors, dividend distributions, and mergers. Shareholders who can't attend in person vote by proxy. They also have the right to question directors and managers at the annual meeting. Shareholders can also submit resolutions to the board at the annual meeting. A resolution may encourage the company to change policies, adopt certain social initiatives, or reform company operations. These are often non-binding advisory motions that may or may not be implemented. Binding resolutions become part of the company's constitution and bylaws and require the board to act accordingly. Shareholders who feel directors and management have acted against shareholder interest or mismanaged the company's finances have the right to sue. If they want a policy change or to shake up the board, they might engage in activism, which can involve litigation or complaining to the press. Activist investors are typically specialized hedge funds that buy minority stakes in companies to change how they're run. Some of the most famous names in activist investing are Carl Icahn, Bill Ackman, Nelson Peltz, and Dan Loeb. But most annual meetings are low-key and focus on administrative tasks, electing directors, approving financial statements, and other tasks. And some annual meetings look like a convention, such as Warren Buffett's Berkshire Hathaway meeting, which attracts investors to Omaha, Nebraska. The event has been dubbed Woodstock for capitalists, with a range of social activities and shopping opportunities. A few companies give shareholders additional perks beyond the ordinary financial benefits. For example, someone holding at least 100 shares of the parent companies of Carnival Cruise Line and Royal Caribbean can receive shipboard credits of $50 to $250 when they book a cruise. Intercontinental Hotels gives shareholders discounts on room bookings. And Swiss chocolatier Lindt presents voting shareholders a gift box during its annual meeting. But with a share price of 100,000 Swiss francs, which is more than $110,000, that may not be a sweet enough reason to become a shareholder. Being a shareholder comes with several risks and rewards, as well as rights you can exercise. But for most everyday people who aren't Wall Street professionals, being a shareholder mostly means monitoring the stock price for your portfolio and collecting dividends. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. And we'll see you next time.